Welcome back. A record low 14% of consumers nationwide believe it's a good time to buy a house. That is based on this new survey from Fannie Mae just announced last week here. It says only 14% of consumers believe it's a good time to buy a house, a new survey low. By the way, 85% believe it's a bad time to buy a house. That is a new survey high. This is Fannie Mae's Home Purchase Sentiment Index, or their HPSI. Consumers' perceptions of home buying conditions remain overwhelmingly pessimistic, as 14% believe it's a good time to buy a house, a new survey low. The pessimism could be attributed to high home prices and high rates as well. To me, this makes sense because when looking at the median sold price according to Redfin, for the 4 weeks ended December 3rd this year, we're at $364,000 on a national level. That means that home sold prices over the past 4 weeks have increased by 4% compared to 1 year ago, even though rates have been at or above 7% for quite some time. On top of that, when looking at the median sold price back at the same time frame in 2020, which is more or less right there, the median sold price was at $301,000. This means prices have increased by about 21% since 2020. Additionally, when looking at rates today, which is on Monday, December 11th, the average 30-year fix is at 7.10%. That's the average for people with great credit. Jumbo loans at 7.55%. 15-year fix is at 6.50%. A 30-year fix for FHA or VA loans, FHA is putting down at least 3.5% down. VA loans require a 0% down payment. In any case, for those two loan products, it's at 6.44% approximately. Also, when looking at rates 1 year ago for the average 30-year fix, 1 year ago, we were looking at 6.38%. This means rates have increased by about 72 basis points or 0.72 percentage points over the past 1 year. Now, having said that, even though rates are still up compared to 1 year ago, they're down greatly compared to the peak that was set back in October 19th this year at 8.03%. That was a 23-year high when looking at daily rates. So rates have more or less decreased by 1 percentage point ever since then. Also, when looking at rates according to Investopedia, as of today, which is December 11th, the 30-year fix is at 7.43%. One reason why this rate tends to be a little bit lower compared to the Mortgage News Daily at 7.10% is because Investopedia.com looks at a wider range regarding FICO scores. So for example, they look at a FICO score in the range of 700 to 760, whereas the Mortgage News Daily looks at rates over 740 for people with great credit. By the way, if you guys are looking to refi, you're not going to get 7.43%. At least that's not the average rate today, because according to them, the average rate for a refi is at 8.01%. So in any case, getting back to Fannie Mae's report here, a lot of people are less pessimistic regarding our U.S. housing market because of high home prices and rates still. At the same time, consumers have expressed a reduced sense of financial security, with fewer respondents reporting household income increasing compared to 1 year ago. The combination of persistent housing affordability challenges and less rosy household finances remain the primary drivers of the low level of plateauing housing sentiment. Regarding the less rosy household finances, here is a great snapshot looking at consumer debt. The amount of credit card debt on a national level increased to the highest level on record going back to the 1960s. This is according to the Fed. So right here, total outstanding revolving debt, which is credit card debt, reached $1.3 trillion, $1.295 trillion to be exact, the highest levels since the 1960s, I believe January of 1968. On top of that, this is about 19% higher compared to 2019, because back then there was $1.092 trillion. Now there's about $1.3 trillion. What's wild about this increase as well compared to pre-pandemic levels is the interest rate that people are paying on their credit cards. Look at this. August this year, the most recent data we have from the Fed, the average rate for a credit card is at 21.19%. That's a big increase compared to 2019, when the average rate was about 15%, 2018, 14.22%. So not only do we have all-time record highs for credit card balances, but rates have increased big time compared to pre-pandemic levels. So here's a look at our good Uncle Fred here, looking at consumer balances for credit cards. Again, all-time record highs right now. Zooming out, going back to January of 1968, you can see here all-time record highs for credit card balances, and has been increasing big time really ever since the spring month of 2021. Additionally, ever since April of 2022, we have been well above pre-COVID levels, and again right now at all-time record highs. Now, something to point out here is that even though we have all-time record highs for credit card balances, we're also at very high levels of delinquency rates of credit cards as well. Look at the past 5 years here. So the delinquency rate of credit card balances, this is according to the Fed, is at 2.98%. That's for Q3 this year. Going back over the past 10 years here, we haven't seen levels this high. In fact, just zooming out over the past 20 years, let's have a look at that. The rate right now at 2.98% is the highest levels going back to Q1 of 2012, when at that time the rate was at 3.06%. So when Fannie Mae talks about we have this less rosy picture regarding household finances, that makes sense, right? Given the data I share with you guys, all-time record highs for credit card balances and delinquency rates for the third quarter of this year, the highest levels since the year 2012. Fannie Mae also says here the lack of household inventory is likely to remain a challenge for some time, and home purchase sentiment may continue to be surpassed or suppressed as a result. As our forecast indicates, we believe it'll take a couple more years before home sales return to normal pre-pandemic levels. So for example, right now, we're on track to be about 4 to 4.1 million existing home sales. If that actually comes into fruition by the end of this year, we'd be more or less at a 13-year low regarding existing home sales on a national level. Fannie Mae also says here that even if rates decrease over the next year, which we are currently expecting, that's their housing market forecast, it's unlikely to meaningfully affect affordability. So we're seeing here that even though rates are forecasted to decrease in 2024, that's not really going to improve housing affordability. In my personal opinion, that's because rates are still going to remain elevated, at least that's what they're forecasting. And of course, home prices still remain very high as well. Now, speaking of that, here's Fannie Mae's latest housing market forecast. So in 2022, the average rate was at 5.3%. That's the average for a 30-year fixed rate mortgage. Then next year, their forecast is at 6.9%. Now, keep in mind though, that even though they're forecasting that overall next year, we're going to have a higher rate, they're actually forecasting that rates will decrease throughout 2024. So in Q4 this year, the forecast is at 7.7%. Then to decrease every quarter thereafter, this is Q1, Q2, Q3, and Q4 of 2024. So rates to decrease for the remainder of 2024, as well as through 2025. So therefore, in Q4 of 2025, their real estate market predictions is at 6.8%, a fairly big decrease from the 7.7% rate we're seeing this year. Now, the reason why they believe that housing affordability will not improve based on this is because they're forecasting that home prices will increase next year. In fact, their forecast based on their HPI, which is their home price index, is a rise of 2.8% next year. They're forecasting we're going to see an increase of 6.7% in 2023. So therefore, because prices are expected to increase by 2.8%, the steady decline in rates is not going to really help home buyers because prices are still increasing next year. Now, I will say though, is that even though prices are increasing, the increase on a quarter by quarter basis or a yearly basis is actually decreasing. Let me just briefly explain here. So in Q1 of 2024, compared to Q1 of 2023, they're calling for prices to increase by 6.7%. But for the rest of the quarters here, so for example, in Q4 next year, compared to Q4 of 2023, they're calling for an increase of 2.8%. So even though they're expecting an increase in prices overall, on a quarter-to-quarter basis, that increase is actually decreasing. And by the time we hit Q4 of 2025, they're forecasting for prices to decrease by 0.4% compared to Q4 of 2024. Okay, let's talk about this survey from Fannie Mae here. Again, this is their Home Purchase Sentiment Index, or their HPSI. So they ask consumers, is it now a good time to buy a house? Is now a bad time to buy a house? And also, is it a good time or a bad time to sell a house? So a good time to buy a house decreased to 14%, again, an all-time record low. The previous month, which was October, was at 15%. That was the previous all-time record low. So we have 2 consecutive months in which we saw record low levels here. In regards to people who said it's a bad time to buy a house, 85% responded here said it's a bad time to buy. That's a new all-time record high. In regards to is it a good time to sell a house, that actually decreased from 63% to 60%, whereas 40% believe it's a bad time to sell a house. In regards to home price expectations, 41% believe that home prices will increase over the next 12 months, whereas 24% believe that home prices will decrease over the next 12 months. In regards to mortgage rates, 22% believe that rates will go down, 44% believe that rates will increase, whereas 34% believe that rates will remain the same we have right now. In my personal opinion, I would be shocked to see an increase in rates next year. I would forecast that, just like Fannie Mae is predicting, that rates will steadily decrease throughout 2024, even though we may end up at a higher rate overall for the year compared to last year or compared to 2023. In regards to job losses, 76% believe they're not concerned about losing their jobs in the next 12 months, whereas 23% are concerned about losing their job over the next year. In regards to rate changes this week, on Monday, there wasn't a lot of news that affected rates today. Average daily rates as of Monday is at 7.10%, as I shared with you guys. But what really could impact rates this week is on Tuesday, December 12th, which, by the way, December 12th is my mom's birthday. So please leave me a comment below to wish my mom a happy birthday here. I'll tell her to read the comments. In any case, on Tuesday, which is when I'm posting today's video here, the CPI report regarding inflation numbers for the month of November gets published. That really could impact rates, whether we see an increase or decrease on Tuesday. Then on Wednesday, we had the PPI report, which is the prices that producers pay, which is a gauge of inflation on the producer side. That gets released on Wednesday, which also will impact rates as well. Also on Wednesday, December 13th, the Fed will announce their decision regarding their interest rate changes. The strong forecast, or the forecast right now, is expecting that the Fed will not change the federal funds rate on Wednesday. That is by over a 95% probability. No one's expecting that the Fed will increase rates on Wednesday here. But what they say, though, regarding their projections could impact rates, though. On Thursday, we have core retail sales, which will be posted on Thursday morning. And then Friday, not a lot of news. Therefore, mortgage rates this week could be absolutely all over the place based on the latest reports that will get posted this week. With that said, please leave a comment below with your biggest takeaways from today's video. I appreciate you guys watching today's video, of course, and of course, for supporting my YouTube channel. If you guys haven't subscribed just yet, I invite you to do so. Hope you guys have an awesome day and look forward to seeing you on the next video.